Hello, everyone, and welcome to another episode of the Real Estate Development Insights podcast, where we bring you ideas, experiences, and best practices from the real estate development industry. My name is Payam Nursalahi. I'm the president of Denal Project Management, a construction and project management firm that helps real estate developers define, design, and deliver successful projects. My guest for this episode is Max Goyzman. He is the Vice President of Financing at Peakhill Capital. Max has a long resume and long history of dealing with CMHC-backed lending, CMHC-insured lending. Max has participated in the closing of over $2 billion in insured and conventional transactions for institutional and family offices across Canada. In this episode, my goal was to mainly dive into financing for apartment buildings and financing for purpose-built rental projects, which is currently the hottest topic in our market, if not the only topic. And what I tried to do with Max in this episode is to talk from the perspective of a new developer from very early stages, if this is your very first project. The reason being, these days, one of the things that are happening in Toronto and GTA is that we're seeing a lot of multiplexes and multiplexes are bringing first-time developers. So we try to create a path and a roadmap, if you may, in this episode in terms of how to approach it, what to do, what not to do. And we also touch on challenges and trends in mid-rise projects, the impact of interest rates on rental projects, understanding the bonding requirement, how to finance the multifamily units in terms of purchasing and transition at the end of the project. And as always, you can find more information about our podcast, our guest, and this episode on our website. Please go to realestatedevelopmentinsights.com, realestatedevelopmentinsights.com. That's all one phrase. And please remember to subscribe to the show. Help us grow the show, please. And if you like what we have here, our content, if you think it's useful, please remember to share this episode with your friends, family, and colleagues. Thank you and enjoy listening. Hello, Max. Welcome to our show. How are you doing today?
I am good. How are you doing? Thanks for having me.
Fantastic.
I'm a huge fan of the podcast.
I appreciate that. Thank you. Please introduce yourself to our audience. We'll go from there.
Yeah, so my name is Max Goyzman, Vice President Financing at Peakhill Capital. We're a commercial real estate lender, primarily focusing in the apartment space. Big CMHC lender, that's most of our book. We'll do $5 to $7 billion a year in CMHC-insured financings. We have a large bridge fund to do bridge financing, 1 to 2 year interest-only loans and construction loans as well. But also we'll do all asset classes. But for the most part, I've been focusing on apartments and have helped a lot of clients in various sizes, anywhere from a 5-plex to a couple hundred units, where things work, where they don't work. So getting good exposure across the country, especially Toronto, Southwest Toronto, those sorts of markets.
That's pretty good. Thank you for the introduction. I wanted to try and actually hit all of those things that you just said in this episode. My hope is that by the end of this conversation, if we have listeners who are looking to finance their very first project, apartment or unit rental build project, they have at least a guideline or a map, if you may, to be able to some degree navigate the process, know at least a 10,000 feet view of the whole thing. Obviously, there's going to be a million nuances and variations to everything. But let's start with that. I guess let's start with this question, very basic. I want to develop an apartment building, which is not a condo, and it's not a for sale project. So I will have to keep on to it for a while until we get rents. Walk us through that process right off the bat. Do you guys as a lender prefer condos or rentals?
We'd be doing predominantly rentals. We can do condos. We can do them for kind of higher leverage or special situations where we wouldn't be competing against the banks as much. But we're really rental focused. And the way I look at it is, hey, let's look at your deal. Can you pull out, CMHC will finance up to 95% of cost. If you can get there with your construction costs and your value and the rents and the loan, and you could pull out almost all your money, and go on to the next one, then it's feasible. So that's high level. That's how we look at it.
Can we elaborate a little bit on that? So you're saying if I come to you and I say I need $30 million to run a project, basically in terms of financing, and CMHC is saying, like, we're going to assume that there's 95% of that, which is what, 26 million, come out of CMHC financing, or actually, did I get it right? Is it just 95% of just the construction cost?
Should be 95% of construction costs. So
let's assume a $20 million construction cost, 95% of that is about 19 million. So 19 million of the 30 million will come from CMHC. Walk me through that from that point onward. What would I need to bring to you in terms of equity for that deal to work?
Yeah, I mean, first, we have groups that approach us and they say, hey, like, this is my site plan. This is the amount of units that I have. We were building condo. Now we might be looking at rental. We're getting a lot of those inquiries recently. They're like, how would this look? So I go, 2 questions. Firstly, how much is it going to cost you to build? Everybody has a different answer for the same site.
Right.
You might get 10 different answers. And then what do we think we can rent these units for? And just with those 2 pieces of information, I could probably tell you whether or not you're going to be 95% of cost, you're going to qualify to pull out all your money, or you're going to be at 60% of cost because your construction costs are way too high, or the construction manager you're using is too expensive, or the deal just doesn't make sense. You pay too much for the land, your rents are too low, not enough units. So just judging based off of how well your loan will cover your construction costs, you could determine quickly whether or not it's a feasible project.
So I want to double click on all of those things. These days, like most of the projects that I see at least happening are the kind of mid-rise projects. I don't see too many 50 stories to 60 stories happening, and I don't necessarily see any or too many 4 stories or 3 stories happening. Let's pick a mid-rise project. And like in these days, and we're recording this in August of 2025, what are those numbers? Maybe just give us some ranges and examples of what would reasonable hard costs be on a mid-rise job, or what would be a reasonable rate of return that you guys would expect to see on a project of that type?
Look, I think I would almost disagree. I would say at the 3 and 4 story level, we're seeing 10 units and under. You're seeing a lot. I think we're seeing a lot more than that than we are seeing a true like 6 to 8 stories on the rental side in Toronto. Because
so 10 units and under, you're saying it's the busiest right now.
For us, like we'll have, my team has 25 to 10 plexes on the go right now in various stages. Certain groups are building, 5 to 10 plexes at once.
Interesting.
They're trying to get scale that way by building them very quickly. On the mid-rise side, I find that the performers, your construction costs start to get a little bit higher after you hit 4 or 5 stories.
True.
The systems in place are more expensive to build out, and you're using different trades that are more expensive. So I think that space, the 6 to 8 stories, that true like missing middle, will take off once we have clarity on those those regulations where you can build as of right 6 stories. It's still under appeal. You need to get rid of those setbacks, increase the density a little bit more, because I still think construction costs are too high. Like you want to try and get under $300 a foot
on the construction
on hard costs. Yeah.
Wow.
I think so. Not everyone's getting there. They're at 400. I don't know if they're so happy to be at the 400 per foot level, but I think that with advances in technology to build missing middle faster, to reduce interest costs, and then also to actually create, if it's like a modular build, the panels faster, transport them more efficiently at a cheaper cost. If you get that down to 350 a foot, then you're going to see a lot more. We'll get there. I think that's working. I agree with you.
On the mid-rise projects these days, the numbers are really hard to make work. They're very tight. They're turning out to be very expensive. And basically what I think is at least partially happening is that we're holding the 6 stories and 7 stories and maybe even 8 stories to standards that we would hold even a 40-story building. Basically, we're very cautious, very stringent with the guidelines, and then every single line item starts growing in cost. And I've seen many projects that it's really challenging to make numbers work. And frankly, so many of them these days don't. That's why we don't see hundreds of them going on. Let's talk about the interest rate. There's a whole aspect to interest rate decisions that we've experienced over the past, I don't know, maybe half a decade or more now, which was it went down. We have those massive chunks of cheap money pushed the condo market up, and now we've been experiencing the other side of it for the past 3 years. How does that whole movement affect your side of business, which is more on the rental and long-term hold decisions?
Yeah, I think when interest rates went down, there was a lot of stimulus in the economy, a lot of inflation, which pushed rents up a lot. So that when we saw interest rates come back up, it wasn't as disastrous as we thought for a lot of these developers. A lot of them got bailed out because rents went up faster than interest rates went. We're seeing a lot of relief there. Right now, rents are stabilizing, declining in some parts of Toronto for sure, but across the country as well. The question is, where will we land? Where will rents stabilize versus where interest rates will stabilize? Right now, I think in many parts of the country, rents are at a level that are still elevated from pandemic times, and rates have come down a bit. If we get a few more rate cuts, I think if rents stay where they are, it's going to start looking a lot more attractive. For example, you have your long-term interest rates for CMHC deals are, let's say they're at high threes right now, maybe 375 at best. If you get that down 50 basis points to 325 and rents you're going to have a lot more activity. So rates are still a little bit elevated, so that we're not seeing the same boom as we had during COVID, but it doesn't need to move that far if rents stay where they are. So we don't need rates to go down to 1% because rents are really strong.
So we're almost at the tipping point, you're saying?
I think so. I think if it takes another 0.25% off, things start to get a lot easier, especially with the rents going down. If we see rents go down, but also rates go down a bit, it's okay, right? Mm-hmm. Like it's not the end of the world if rents are going down. We just need to see relief on the other side.
And we were having a discussion with Ben Myers a few episodes ago that when you're underwriting or when he's writing reports for CMHC in terms of rents and stuff, when CMHC is looking at your numbers, they're not necessarily looking at the fact that, or I shouldn't say the fact, or at the prediction that in like 27, 28, 29, rents could potentially have a huge uptake because of the lack of supply that has happened or is happening right now. What are your thoughts on that?
We'll be right back.
Just a quick announcement. If you're thinking about financing your next project, your next rental project through CMHC, and in particular about the MLS Select program, please go to our website and check out our new webinar series. It's a free webinar series where we're talking about different aspects of the program, how you can qualify, how you can get more points. And we basically break down exactly what you need to know to access better terms, higher leverage, and longer amortization. Again, it's free. Again, you can find more information about it at mid-rise.ca/webinars, midrise.ca/webinars. Thank you.
Yes. So I think if you're underwriting a construction deal today and you're going to CMHC today, they're going to base your approval based on rents today. That's the only information that they have. So if you qualify today, let's say it's not 95%, maybe it was 85%, and you're not so satisfied. When you're going to have no deliveries in the end of the 2020s, and you're going to be one of the few new buildings, you're probably going to get pretty good absorption, pretty good rents. Extent where there's a comparable time period, which is actually right now, where people who started building and leased during or around the end of the pandemic stabilize at rents that are probably, they could be 10, 20% lower than where they are today. So there's still a lot of room. They might be sitting at like 50 to 60 to 70% loan to value when CMHC originally underwrote them at 90% of value 5 years ago. And you could have that same situation in 2029 where, yes, you might still have a little bit of money in it, but now you've been stabilized for a year. You can go back, get a top up to your loan, pull out all your money and still be left with some cash flow and an amazing asset. So it comes down to if you believe in the fundamentals,
Right.
believe in the fundamentals, you know that there's going to be demand for this type of asset and it's going to be in a great city for a long time. If we're talking about Toronto, then yeah, I think whenever you don't have a lot of new supply, you're not dealing with much competition, right?
So you have to really try hard these days to make sure that you get your numbers to work and you can get your financing in with the hypothesis that in 2 or 3 years there might be the decent jump in your rates and you actually end up on a better end of the deal. And I guess on the flip side, CMHC insuring these loans, they are doing a dollar cost averaging, if you may. Like sometimes they're a little bit lower, sometimes they're a little bit higher on their own portfolio, and it probably ends up balancing each other out. Is that a fair statement?
How do you mean dollar cost averaging?
Meaning the example that you just gave, that at some point CMHC might have underwrote a deal where at 90% where those rates are not actually happening, that the rents are not happening. But on the flip side, they might underwrite deals at 70% these days, which in 3 years' time, they might be collecting much higher rents.
Yeah, look, I think CMHC did the right thing. They said, if we're going to underwrite you today based on today's rents and you're at 95% of value, your premiums are going to be much higher than they would be if you were at 65% of value. They made that new dynamic pricing model for their insurance product. Originally, they were like, at the end of the year, before the election, they said, we want to back off. We want banks to step in, take on more construction. In my opinion, I think when the Liberals won, Carney won, he actually wants to get the government more involved in housing. So that's counter to what, it's counter to what the narrative was prior to the election when Pierre said he wants to rip apart CMHC. In a good position now, I think the feds are going to continue to support new housing. You're still seeing good success, good offers come for smaller deals, million, very high leverage during construction. Yeah, look.
So did you say 50 or 15?
Under 50, like you don't have to deal with the same scrutiny from CMHC.
Okay, that's good to know.
So that's more mid-rise stuff, right?
So on the smaller projects, you're saying CMHC on up to 50 million is going, let's say it has favorable conditions. How small do we get? Like I had this conversation with someone who's investing in these properties, and they were suspicious or skeptical, if you may, in terms of what is the smallest size that it actually makes sense to go through all the hoops and make it happen. Is it the 5-plex? I know you just mentioned that you have a whole bunch of that, but does it for an average, call it these days, citizen developer or owner developer that has a house and wants to go to a 5-plex or 6-plex, is it worth it? Does it make sense?
Honestly, I personally would, because I know groups that are comfortable doing it now after having done it once or twice. And based off of where the rents, based off of the low risk from the city and regulation, because now there's more demand from the city. They're easier to work with because it's more proven out just to do a 5-plex and you can get up to 95% of cost. Maybe it's not going to be your full-time gig. Maybe you're not relying on this 5-plex to carry you and pay for your bills, pay for your family, but you're doing one a year, then 2, then 3. It adds up. So you just need to scale. And if you are able to replicate what you're doing on one lot, on another lot in the same area, you get comfortable and knowing that it's not a lot of capital at risk. It's not a huge construction risk and it's manageable. Yes, it's small, but you're not dealing with the same competition from institutional developers.
But exactly. And your risk is lower.
And your risk is lower.
Yeah.
And you want to build. We have really established groups now starting to get more interested in this smaller scale program. And if you start building these projects out on a programmatic basis, suddenly you can build up a portfolio of 100, 150 units quite quickly. Mix in a few 10 units there. There are some groups doing 5 to 10 unit projects at a time. So
that's interesting.
It's not so small potatoes. Yeah.
Yeah, that's good to know. And I agree. Like we had a conversation on a couple of posts on LinkedIn a few weeks ago, where if you compare the attitude toward these smaller projects on 5 and 6 units in Toronto these days, compared to the mid-rise projects that are 30 or 60 units, it's night and day. The way they could work out is, like you said, a smaller scale. You might not be able to carry all the overhead that you would have on a 60 unit building, but at the same time, if you can get in and out of a project within 12 to 18 months and get your risks minimized, basically, why wouldn't you, compared to the project that you and I are involved in? And I don't want to name names here, but that like those projects you're involved in for 5 to 7 years, depending on how you look at it. And that's much longer risk period outside of CMHC, because sometimes I get tired of hearing and talking about CMHC all day long. It seems to be the only game in town. Is it the only game in town?
Yeah, for apartment rental, absolutely. I mean, what else is offering 40, 50-year amortizations? You're getting for the same monthly payment, you're going to be getting 30% more loan proceeds.
Right.
So the conversation just ends there.
That's it. So then we just keep it to CMHC. Okay, so let's hope they keep it.
Like in terms of apartments, right? Condos are a different beast, but
yeah, no. These days, with the market the way it is, condos are, I think, at least a couple of years before we see a rebound, if that. Let's go back to our first-time developer. I have a house. Potentially, I can do a sixplex these days in Toronto. Walk me through the steps, please. What do I need to know? What do I need to have prepared? What's the roadmap? Give me a 5-10 step roadmap, please.
Sure. So say you're an individual that owns a house you've never built before. I don't know how many of your listeners would fall under that bucket, but there's certainly a lot of people that are in that situation. And first thing you do is approach somebody like a developer manager that knows what they're doing, because you're not going to figure it out on your own by yourself. It's probably not going to happen. You need to leverage off of somebody who's done it before. So there's a lot of people who are building the 5-plexes, and they're also offering development management services on the side to add some density to whoever their neighbor's property. So number one, that's the first thing I would do. So you got to have the right amount of frontage. You're not going to have 10 feet, right? You want to have whatever it is, 30 by at least 150 or 140, 135. And you want to reach out right away. There's too many people out there that are trying to do things themselves, and they're exposed pretty quickly when you find out that they don't have a track record. So leveraging off of somebody's track record is what you need to do.
Record? How do you define track record? Do you guys or does CMHC look at exactly having done that type of project before? Is that track record?
Doesn't have to be exact.
I mean, if
you're working with or you are a custom home builder, probably you can pull off a 5-plex or a 10-plex. Most of these investors, developers in this space had some exposure to custom home building. In some instances, more complicated of a build. Rental is more cheap and cheerful. So I would say that having that experience is probably pretty helpful, because they know how to manage costs, how to manage labor, how to procure materials, manage schedules. So there's all these skills that you need, regardless 100%. of the scale, even though it's 5-plex, that I would just leverage off of somebody else.
Yeah.
That's
so I got my development manager or /builder or construction manager or project manager. There are different names for it out there. I got my trusted partner, who knows or who has a track record. Then I want to try and figure out my finances. Do I call Max right away?
Well, no. I mean, you got to know what you're building first. Many of these experienced investors or developers, they could look at a property and within same day, they could turn around a very simple unit layout in a unit mix. Like, I could build 5 2-beds or 7 3-beds or 15 whatever, and this would be the unit mix. So you need to go back and forth with an architect potentially, and then have an idea of what you can build. And then after you figure out what you can build, you don't have to go down the route of figuring out what you can rent it for. That's pretty easy to figure out rents, but how much is it going to cost you to build it? If you're building it by itself, it's going to cost you, by yourself, it's going to cost you potentially an arm and a leg. But if you leverage your partner who's done it before, he or she may be able to tell you pretty quickly. So that's when you call me and say, hey, this is roughly, or I can put you in touch with the right person. This is roughly what I want to build. This is roughly how much I think it's going to cost. And then you work backwards from the pro forma. If this is what you're going to build, 7 units, $3,000 a unit in rental income, I can work backwards to the loan amount and tell you what you need to build it for, what your construction budget has to be. If you're buying land, what you have to build it for and what you have to pay for the land. So it all comes back to how much of a loan can you get to determine what your required equity is, which then determines your returns, your ROI, and you work backwards from the loan amount to determine your construction cost.
How much you can, basically how much you need to spend. Okay, so let me ask you a couple of different questions. And then I guess it used to be that when we were building condos a few years ago, banks used to have this threshold of either you receiving, 65, 75% sales. And also at some point they wanted us to provide 75% LOIs or written contracts with trades just to basically get some certainty on the revenue and the construction cost. Do we have a similar provision when it comes to building a small 5 or 6 unit building?
Most of the time, at least with CMHC, and if you went the private lending route, which is also for construction, it's also possible. The lenders might want to see some level of fixed price contracts, which doesn't always exist when you're building like at such a small scale.
Yeah.
You can get quotes and you get away with that. But like at any scale, like CMHC wants to see 2/3 of hard costs fixed prior to construction starting, or you just enter into fixed price contract with a CM, and that'll count towards it.
Right.
So that's how you get around it. Yeah.
Okay, so that's one side of it. And I know on certain scale projects, the CMHC starts asking for bonding of certain trades and bonding of the contract. At what point in time does that kick in?
It varies, but generally above 50 million in loan amount, you're going to need bonding.
Okay.
Yeah.
But lower than that, like on these small projects, you don't typically need to worry about that, basically.
Honestly, they've asked before, and a lot of our responses is our clients, developers, they've investigated, and they're not able even to find an insurer for this type of project. And even on larger projects, like I know we've been down this road before, that even if you go for a $25, $35 million loan, it's still very hard to make numbers work and also pay for the premiums of the bonding and find bondable trades at that scale, there's a whole other story. And okay, so let's go back. That's the bonding. I've come up with a massing. I know how much I'm going to build. I have a partner who's giving me numbers. And how does this whole financing situation interact with, let's assume I still have $100,000 worth of mortgage in my house, and I want to come to you and I want to do this 5-plex or 6-plex on my property. How does this interact? Do you guys pay it off? Is there an LTV in the mix somewhere, or is it just an entirely separate setup? So say right now you have $500,000 equity in your house, and you want to build a 5-plex or a 10-plex, and you get approved for CMHC, and your required equity is only $500,000. Mm-hmm. That means as soon as you start work, you can start to get draws, and any amount of money that you're spending is going to be financed by the loan. And that's why you have a lot of people so attracted to this opportunity, because they've built up so much equity in their homes that it's accounted for much more equity than you would need for the purpose of qualifying for these construction loans. So it's not going to cost you any money, and you're going to potentially build more equity, right? By creating a bigger project. So that's
it's not like you need
the
to pay off the mortgage. Sorry to interrupt you. It's not like you have to actually pay off the mortgage and pay any penalties or anything like that.
no,
It will come
it's
in
paid with the first draw.
Right.
So assuming you can wait, your first draw of the construction loan is going to repay your existing mortgage.
Oh, so you are discharging the mortgage and replacing it with the whole CMHC package as a whole. It's not coming at a second. Gotcha. Even on the smaller jobs.
It can happen at the same time. Some people even line up the purchase of a property to happen at the same time as the draw of the construction loan. They're trying not to spend any money at all. So everything can happen on the day that you're getting the construction draw. Yeah.
Interesting. Okay. So I have this set up. I'm going to go through the draw, and draw for those of our listeners who haven't been through it basically is that at the end of each month, we submit a whole package. Sometimes it's in hundreds of pages, including receipts and backups and sign-offs from consultants. And basically say this past month, we did this much work, and this is the percentage of progress, and this is who said we did it right, and please pay us for it. That's considered a draw. And there's typically a cost consultant or payment certifier involved, depending on the type of contract, and says, yes, these guys are right and they're not lying to you. So that's the draw. But outside of that, things should flow. We go through the construction, we go through the occupancy process, 6 months later, 12 months later, 18 months later, whatever the timeline is. Walk us through that. Then we've paid the draw, we have our final draw for construction, release of holdback and everything. What happens then?
If it's an apartment building, then all you got to do is potentially lease up. CMHC is recently, they've been saying, prove that you've leased up and have met these and achieved these rents. Previously, you used to just have to show an occupancy permit, and then you can convert your construction loan into a term loan. So you pull the full loan, you have 95% of cost, and you lock a rate, whatever it is, 4%, and you start amortizing and making your monthly principal and interest payments. So it's all like in the same package.
Like regular mortgage you would. Basically,
like any regular mortgage. If you started with CMHC, then you don't have to pay any additional fees. You just keep it going and convert it to the term loan.
Gotcha. So, and is there, I know you guys also do a lot of bridge financing. I've talked about that before. Is there potentially a need for a bridge to come in between your occupancy and your lease up or stabilization? Or is that just going to follow through?
Look, it depends how you're financing. If you've gotten a private loan for the construction, you need a little bit more. There's lenders like us, they could top you up until you've leased up and you're ready. I find that at these smaller scale projects, you might be able to get started faster than you can get the financing. The biggest thing is get ahead of things with your financing when you have these small projects, because by the time you have your building permit, you don't want to wait 6 months to get a draw. It doesn't make sense. The whole point is to do it quickly.
Yeah.
So a lot of times you might have construction that's started, but the financing isn't ready. So you have to pay out of pocket. So there's bridge solutions available when you've started construction and your financing isn't ready yet. So
but what if you're on a CMHC basic transition form? You will not end up in a need for a bridge, right?
No, I mean, the benefit of if you're getting 95% of cost during construction is that you only have 5% equity at the time of the first draw. So you're keeping all your cash in your jeans and you don't have to lock it up until you've leased up, which is the alternative when you're working with a private lender.
Okay. And toward the end, because the reason I'm asking this question, sorry, and I'm lingering on it, is that a couple of years ago when we used to finish these rental projects, sometimes it would take months and months, especially on the larger ones, to be able to get to a decent amount of lease up. This would take, one particular case, it took us about a year to get to, after occupancy, to get it like 50% lease up. And I'm just wondering, if you have CMHC financing in that condition, what is happening? Because you've already exhausted your construction draw and you haven't necessarily reached your lease up threshold.
Yeah, it's a good question. In the past 5 years, you've been able to take the term loan just with the occupancy permit, so that hasn't been an issue. You didn't have to achieve a certain level of lease up. But yeah, in this market where rents are hard to pin down, you don't know if they're going lower or they're stabilizing or going higher. And in some instances, they are declining. CMHC is going to require that you keep the construction loan until you've reached full occupancy.
Mhm.
And they'll have a holdback on the loan for that. You're going to have to extend your construction timeline.
Right.
We're doing bridge deals where, like massive bridge deals on large 80, 90, $100 million projects, where that's exactly the case. Is you have lease up, it's not yet done. We still haven't demonstrated to CMHC that we can achieve these rents. And yeah, it's a big risk. It could double your interest cost because
Yeah.
your construction rate might be double what the CMHC rate is. So it could very well double your interest cost for a year while you stabilize.
While
So
you're doing it. So that's one of the risks you need to be aware of when you're putting together your pro forma, or at least maybe start the lease up process a little bit earlier than you like, just to make sure you got it in place, or at least some leads in place for you to not have to sit on it for too long. Like you said, especially on these smaller projects, the whole thing I think is just to get it in and out quick. So at least from the risky stages.
Yeah, you just need to keep cash in your jeans. You need to have 10% liquidity or whatever it is, 10% of the loan amount in cash set aside outside of contingency for those reasons, especially if several projects on the go at once.
That's always good advice. And that's in this context. And for those of our listeners, and I'm going to ask you, what, aside from what you just said, what is a good contingency to have in your experience when you're going into a project? Because the last thing you want is to go into lean and get stuck and something happens. And especially on these smaller projects, that has been one of my main concerns per se. Like on a larger job, something goes wrong. Typically, if you catch it early enough, the contingency will at least be able to cover you and you won't be stuck. On these smaller projects where the dollar value might not be more than a couple of million and your contingency might be, I don't know, like 100K or 200K, all of a sudden Enbridge comes out and say, oh, by the way, we have a line that was buried there. Oops, we didn't tell you before. Now you have to pay 150K to move it. Then you're not going to sleep so well at night.
Yeah.
What is your recommended threshold for a reasonable reserve or contingency overall when going into the project?
Look, from a lender's perspective, your contingency just to get financing has to be 5% of cost to complete, but that doesn't account for change orders or surprises. So what we look for is 10% as cash liquidity outside of the project. Cash or like stocks or more, you need more than you think. So if that's a $10 million deal, you want to show at least $1 million cash just outside
sitting
of
around
what you've set aside for your project, which is a lot.
Right.
And without it, your options for financing are still there, but not as ideal in terms of pricing and flexibility. And potentially even how aggressive CMHC might get with their offer. The more liquidity that you show, the stronger that you make yourself look, the better CMHC is going to receive your application and the more risk they're willing to take on you.
So with that said, aside from the actual decent amount of contingency and liquidity to have, are there any other red flags or big mistakes that you've seen some developers do, or I would assume smaller developers or newer developers do, that you would say, buddy, don't do that. Just be careful with that. Anything comes to mind?
I think, look, in terms of design, it is what it is. Like it's hard for me to comment on design, but what I can say as a financing professional is ahead of it, be like 6 months ahead of when you need the first draw, because you don't want to be in a position where you've exhausted your cash reserves and your project stalls because you don't have your first draw ready. So being prepared and engaging your lender early is the biggest thing, because they'll tell you where the obstacles are and how quickly you're going to be able to get the money, because without the money, you could be screwed. You don't want to be working too much in the winter. There's like certain times of the season you want to start. Like there's very specific times you want to start construction. You don't want money to hold it up, because that could ruin you for a long time.
It's one of those things is that once the train leaves the station with construction sites, you better keep it running. The minute you stop, it will cost you an arm and a leg to get it running again. And that's one of the things that I think not too many people appreciate, how expensive it is to keep things running, and how much more expensive is to restart things once they have stopped. And yeah, that's definitely good advice. If we want to go back and zoom out on the whole picture, when you look at, forget about our current date situation where everything seems to be tight, CMHC is the only game in town. If someone has already worked with traditional financing, like one of the major banks, and they have gone through a construction process or development process, and comparing that whole process in terms of feasibility, ease of use, considerations, how does this compare to the process that you would have to go through for an apartment building with CMHC? In other words, if you have gone through a construction loan and like a condo set up before with RBC per se, now you want to do the similar thing on a rental with CMHC. Is this easier? Is this more streamlined? Or walk us through that maybe.
You're saying conventional apartment lending versus
Per se,
insurance.
yes.
So we're doing that now. You have groups looking more at conventional apartment financing so that they could arrange CMHC later, because they might think that CMHC today is being a little bit too risk off. They're not giving them credit for where they think rents should be. And they don't want to lock into a deal that they have to keep once they stabilize in their minds at higher rents. They don't want to leave money on the table. So you do have options conventionally that will allow you the flexibility to prove yourself and prove your lease up to potentially get more money from CMHC once you're ready to convert to the term loan. And those deals are available. We are doing deals at up to 85% loan to cost conventionally. And there's more structuring happening behind the scenes, but certainly it's faster. You don't necessarily need bonding, and you don't have to go through the process and the pain of paying the CMHC premiums during construction. The premiums could be 5-6% depending on loan to value. So it does give you flexibility, and that you can test the market. You can maybe sell the building once you're done and have the buyer put on their own CMHC financing. So there are groups doing that, a lot of them for scheduling reasons. They just don't want to wait. And you're still getting pretty good construction financing right now, given where prime is, or it's around 5%. If you're getting construction financing at prime plus, at 85%, you're going to be about prime plus 2, but lower than that, 70, 75, you're going to get closer to prime plus 125. It's not that much more expensive than CMHC, especially when you consider there's no premium. So yes, people are looking a lot more closely at it, and it's more appealing for sure.
And to your point, if you're already in possession of a parcel of land and property, and you don't want to sit on it before you go through all the hoops, you might, like you and I know, you might start with the traditional form of financing, get your project going, and maybe at some point, which is not going to be fun, but at some point switch to CMHC
you could do it
financing.
midway through construction. You could do it anytime. You just might not want to wait. So that's definitely becoming a more prevalent in the market for sure.
Interesting. I want to switch gears a little bit from new construction and new apartment buildings. Let's go to existing ones, because I think that's also one of the sides of CMHC programs that is not being talked about that much or as much as the new construction side is. And I want to open that up in two different categories. One is the larger institutional holders, and the other one is the smaller ones. And I'll tell you examples of both. Is that we did a project a few years ago for a nonprofit that had 93 units, and they basically figured out a way to add another 37 units in the parking lot they had. And a lot of that came through different government-funded initiatives, including CMHC financing. What are the options over there? And the second type of project that I would appreciate if you can shine some light on is smaller landlords, people who already have a duplex or triplex or a fourplex anywhere in Toronto or GTA, these are typically older buildings. How can they benefit from these incentives, or are there any incentives for them?
Yeah, so I think you touched on a key point in that when you're a nonprofit or you have a partnership with a nonprofit, you have more options with CMHC. That's outside of just their MLI Select or their insurance product. They do have their federal funding products that are a lot of the time just tied to nonprofits or affordable initiatives. And when you have a mix of both, they have a few programs like the Affordable Housing Fund that is geared towards maintaining and preserving existing affordable housing. And there's huge grants available for that, for major retrofits that are potentially forgivable or like interest-free loans. So the problem is that for private developers or private owners, it's not necessarily available, and it's hyper competitive because you're applying directly to CMHC and they're just completely inundated with applications. But
so if you're a landlord, sorry to interrupt you, but if you're a landlord that is privately holding land, there's not too much incentive for you to go after CMHC financing and trying to do the renovations and stuff. Is that what I'm hearing?
Yeah, they're looking at the Affordable Housing Fund, they're looking at ACLP, but ACLP is only for new construction, and it's now really geared towards institutional groups, where it used to be more mom and pop. So yeah, you need to really be nonprofit to get those goodies. They need to be deep affordable units. We're not talking like $1,500 or 30% of the median household income, which when you do the numbers, it's not even that affordable. It's still close to $2,000 a unit. Right. So yeah, you could do the math and it looks too good to be true. It probably is. They're looking for those deep affordable owned type of apartment buildings.
Like $500 a month type of rent.
Yeah, that stuff. Yeah.
Okay, so what about on the smaller scale? And here's where I'm going with this, is that I was recently at an event, and I believe it was Daniel Kleminski from City of Toronto who brought up some numbers in terms of this new initiative that they have on the multiplexes, the fourplexes and sixplexes. And one of the things that is interesting, if I'm remembering the numbers correctly, was that they have received over the period of, I want to say 16 or 18 months that they've had this program, they've received like 450 applications to do these multiplexes. And more than half of it has been people who already have a duplex or have a house which has two separate units with a basement and an upper, and now they're trying to make it into a 4-unit building or a 5-unit building. And basically it's an addition or modification. It's not necessarily a new build. It's an addition or modification.
Like an ADU, the additional development.
Yeah, or just adding like a double garden suite and connecting it to the main unit and just getting creative. There are many creative things that are happening under that initiative. Would that be a good fit for this type of financing?
I don't think you're seeing that because CMHC-insured financing for multifamilies for 5 units plus. We're talking about duplex, triplexes. It doesn't really even qualify as commercial anymore. We're looking for more like residential financing. So that sort of stuff.
It's probably on the line.
It's not really multi-unit in the sense that CMHC and this whole space is looking at. The one-off units, I'm not too sure about, to be honest. Right. And it's not really available for 5+ unit properties.
No, I appreciate that. I want to ask you about a trend that is happening in the market on the larger scale projects, and that has to do with prefab, modularized, and anything that has a component of off-site construction. And I think you know where I'm going with this, is that going back to that whole definition of draw, we have issues with prefab construction under the current structure of draw. And again, to recap, is that like typically traditional construction, you bring the concrete, you bring the steel, or you bring your material, you build the house, build the building, end of the month, you have something to show for it, someone signs off, you get paid. When you're doing prefabricated modular buildings, a lot of times you have to pay months and months in advance deposits that are very significant. In some cases, it could be 20, 30, 40% of your overall hard cost. And then by the time it shows up, you're halfway through the building. CMHC, as far as I understand, does not like that or does not approve that. Or does it? Maybe walk us through that.
Yeah. So they're not going to insure deposits. That we know for sure, but they could insure off-site work that's being completed, provided you have bonding and insurance on the entire process. So
Right.
your manufacturer, the transportation, the work done on site, if it's all bonded and CMHC can be designated or the lender can be designated as the beneficiary, then you'll have a solution. So those solutions are available from CMHC. Deposits, you're probably not going to get them insured, but the work that's being done, assuming everything is bondable. And again, there's challenges with bonding. So that's a whole other challenge that you're going to have to get to, even if you can get CMHC on board. But yeah, it all comes down to bonding and insurance.
So it might be a case that you actually, if you're going through that process or that type of building, you might actually have to use the bridge financing to pay for that whole upfront section until it comes on site, and then you will end up potentially switching to CMHC a little bit later in the process because you actually want to have something to show for it. Because going back again, like I think on average, if you're adding bonding to a project, you're probably adding 10 to 15% cost on multiple levels throughout different line items. So this is probably another place to, and just for argument's sake, what is the premium we're paying on a bridge financing in that condition compared to the actual CMHC financing? Are we like a couple of points?
It depends on the group. It's not a big deal. You might be going from prime minus in the prime minus range, prime minus 25 to 40 basis points with CMHC. And you might want to, if you have a good relationship with your lender, you might get to prime plus 125, 150 to start the construction. And then they can convert it to the CMHC loan once you're ready or in a position. It's not a huge deal. It's a lot of paperwork.
Right.
It's a lot to manage. But at the end of the day, even if you're 6 months into construction and you're getting that 95% loan, assuming you could qualify for it, it's still pretty good because you can.
Yeah, that's a good deal. That's
a good deal. You're taking most of your money out. Maybe not all, close.
Okay. That's good. I appreciate all the insights. Is there anything that I haven't asked you which you think our audience ought to be aware of?
No, I think I've the main points is that get ahead of your financing process, but also at the very beginning, align yourself with partners that have experience and have that vertically integrated process. So you could benefit from the lower costs that they're able to procure on the construction side, because otherwise you can't control that. And there's a lot of profit in there for constructors that you don't want to have to pay it during construction. Maybe you could pay it after construction, but you want to get the benefit of those low pricing. And that comes from builders that have done it before. So that's who I would align myself with, and then figure out the financing later.
Thank you very much. There's something to be said about having done it before and having some experience in the industry. As much as we would like to empower new developers and new investors to come to the market, but I could not agree more with you that please make sure you're aligning yourself with the right parties. There's just our business, our industry is not rocket science. It's not super complicated, but what it is a collection of probably 1 or 2 million small decisions, each of which is going to cost you a lot if you're not sure or you haven't done that before. So thank you very much, Max. This has been fun. We covered a lot of ground, and I'm sure that our audience is going to find this useful, a lot of information. And how do they reach out to you?
Okay, thanks, Graham. Yeah, they could email me. Usually when I go on these type of things, I'll drop my phone number, which is 647-207-5057, or my name, Max Goyzman at peakhillcapital.com. You can email me.
Easy to find. Easy to find. Thank you very much. Have a good one.
Thanks.
Just one last thing before you leave, please make sure to visit our website. We have put together a whole bunch of different resources that you can download for free from our website. These include checklists, manuals, and also access to previous webinars. In case you have missed any of our previous webinars, you can go there, get the replay link, download the slides, and benefit from all these free resources that we've gathered on the website. Please make sure to visit. Thank you.